Hi and welcome to the Stefan Livera podcast focused on Bitcoin and Austrian economics. Today we've got an interview with ErgoBTC, a pseudonymous Bitcoin white hat privacy analyst. But first, the sponsors of the show. So firstly, Kraken, one of the world's leading Bitcoin exchanges. They offer a high quality platform. They offer one of the most liquid Bitcoin exchanges. They have high trading volume and low fees. They've got best-in-class accounting, reconciliation, and reporting services. They've recently announced and launched Kraken Pro mobile app. Kraken Pro delivers all the security and features you love about the Kraken exchange in a beautiful mobile-first design for advanced Bitcoin trading on the go. Kraken also have an OTC desk for those seeking more private, personalized service for large block trades of 100,000 USD or more. Kraken offer margin, long and short, up to 5 times, and futures up to 50 times leverage. Kraken also have the Crypto Watch platform, and they offer 5 fiat currencies. Go and sign up at kraken.com. This episode is also presented to you by Unchained Capital. Unchained Capital is a Bitcoin financial services company empowering customers with unprecedented financial freedom and control. All their products and services are built on the foundation of multi-sig. Their approach to collaborative custody gives users control over their private keys. You can use Trezor or Ledger, and you also get the benefit of having a financial partner and financial services. So Unchained's 2 of 3 vaults are a great option for those thinking through how best to secure their Bitcoin for the long term. And if you ever need to access liquidity but you don't want to sell your Bitcoin, Unchained's collateralized loans offer a unique option. All Bitcoin is stored on-chain in dedicated multi-sig addresses, and the BTC is never rehypothecated. You can also share in the security of your Bitcoin by holding 1 of 3 keys. I'm really impressed with Unchained. I'll be having Parker on the show soon, and they offer excellent services. They've released valuable content and open source tools such as Caravan and Hermit, so I think you'll enjoy partnering with them. Go and sign up at unchained-capital.com. Next up is GiveBitcoin.io, the easiest and safest way to get your friends and family into Bitcoin. Have you ever had that problem where you gave Bitcoin to people but then they lost it? They just didn't understand what they were receiving. That's why GiveBitcoin is important, because you can time lock that Bitcoin gift for 1 to 5 years, and GiveBitcoin will deliver a lesson from a world-class curriculum put together with input from many well-known Bitcoiners such as Safedine, Matt Odell, Jan Pritzker, and others. I'm also an advisor. I have a small equity stake and I'm assisting with the curriculum also. Don't forget, you can get Bitcoin as a present. Birthdays, Christmas, bar mitzvahs, graduation, weddings. You can put it on your wish list. So go sign up at givebitcoin.io. I really think it can have a positive impact on Bitcoin adoption and understanding, so I'm excited to have them as a sponsor. Last but not least, Bitcoin Outlet, which is now rebranding to 21x.io. 21x.io delivers rare and extraordinary merchandise to warriors of Bitcoin. Outstanding design is not blindly slapping a logo on any object available. At 21x, every product they carry is a work of art with a thoughtful design. In keeping with the ethos of Bitcoin, all products created are limited edition. Once that product sells out, that's it. When you purchase something from 21x.io, you'll be one of the only people in the world who have it. It's a sister company to Canada's Bull Bitcoin. Both companies are Bitcoin maximalists through and through. 21x only supports Bitcoin. This core belief has led them to align with other unapologetically maximalist companies. So if you want to rock some merch from a designer with an actual moral compass and unwavering maximalist views, go to 21x.io, grab yourself some of that merch. So today I've got a fantastic interview with ErgoBTC. It's his first interview. He is a pseudonymous Bitcoin white hat privacy analyst or chain analyst. And so he's been lighting it up recently with some of his articles and tweets about the PlusToken scam and the ongoing chain analysis that he has been able to do using tools such as kycp.org and oxt.me and some spreadsheets. And it's just a really fascinating episode. I highly recommend, for those people who are not as familiar with Bitcoin privacy, check out some of my earlier episodes, episode 58 with Chris Belcher, 78 with Samurai Wallet, and 117 with Pura Vida. Otherwise, I do try to break it down where I can, but I think this will be a fascinating interview with some insight into how Ergo was able to track some of the PlusToken scammers, and we talk through a lot of different privacy techniques and their use in practice. So I think you'll really enjoy this interview. Here it is. Ergo, welcome to the show.
Thanks, Stefan. Happy to be here. Big fan of the podcast.
Thank you. Yeah. So look, man, I know you've been doing a lot of really interesting work. I know you are obviously operating under a pseudonym, so we'll be careful not to dox too many components about yourself. But just obviously without doxing or giving off too much of your own anonymity set, can you just tell us a little bit about how you got into Bitcoin and particularly this, what we might call white hat Bitcoin chain analysis?
Yeah, sure. I guess I'm kind of like most Bitcoiners, in that I started out as, looking at libertarian politics and Austrian economics. Those are good gateway drugs that lead into Bitcoin. In the last year or so, I've probably gotten a little bit more discouraged with the current political and economic landscape. Around the same time earlier this year, I started hanging in a few Telegram groups, and I found some Bitcoiners with an ideology that I kind of aligned with. From there, stumbled into crypto anarchy. For those that kind of don't know, crypto anarchy is basically this concept of creating, a parallel voluntary system that people can opt into, as they wish. It's sort of this gray market stuff, and Bitcoin fits pretty much perfectly into that framework. So I started listening to a couple of crypto anarchists do talks, and they're pretty objective. They seem legit, kind of old school cypherpunks, and many of them raise some valid concerns about Bitcoin's on-chain privacy. But with the rise of some of these new non-custodial mixing services, I decided to start doing my own research and figure out if these services were enough to keep Bitcoin from becoming, I guess, its own panopticon, as these guys, seem a little bit worried about. And in the process of doing my own research, I sort of stumbled into something a little bit bigger.
Yeah.
So from there, I basically have been, hanging around looking at these blockchain explorers, mostly OXT and KYCP, looking at different types of mixing services. I've looked at shared coin, I've looked at join market, I've looked at Wasabi, and I've looked at Whirlpool. And during looking at into Wasabi, I noticed somebody was merging really large volumes of Bitcoin into a postmix cluster.
Gotcha. Sorry, can we just back up just for a second there? I want to just make sure this is accessible as well. So maybe we could just talk through a little bit on the basics of blockchain surveillance and what are some of the key methods and heuristics that are applied. So maybe we could just start with some of that. And if you could just outline a little bit around what is the common input ownership heuristic?
Yeah, that's an important one. It's probably one of the most powerful chain analysis heuristics. The merged input heuristic is the assumption that all of the inputs in a transaction belong to the same party. And what this does, or what chain analysis can do with this information, is they can cluster the inputs from a transaction. And if this process is repeated with a handful of other transactions or more, you'll wind up with a bit of a bigger cluster. And what this kind of shows them is that a larger entity might be the owner of many addresses, and that's sort of kind of what sparked this off for me.
Excellent. And for listeners who are interested in some further background, I recommend checking out episode 58 with Chris Belcher and also reading the Bitcoin Privacy Wiki, which he updated. Now, while we're on this topic of merging and common input ownership heuristic and so on, there are, I guess, multiple ways in which our privacy can be doxed when we're dealing with Bitcoin. One of those ways is, again, as you mentioned, the most obvious one is the merge heuristic, because every Bitcoin transaction has inputs and outputs, and then where those inputs are being merged, then that can indicate, well, it's probably the same owner, right? And that's like the general heuristic. Obviously, there are other countermeasures to be deployed against that, but that's the basic high-level way to think about it. But another key angle is this, what Chris Belcher calls data fusion, and that's where somebody might post an address just publicly, right? They might have a donation address, and then the combination of that with on-chain analysis can be what de-anonymizes that individual or that exchange or that large party. Can you just comment a little bit on your thoughts around that?
Yeah, I mean, there certainly are a combination of additional information that chain analysis can use to paint a bigger picture. Bitcoin's pretty powerful. It's got some pseudonymous traits that make it harder to pair to the real world. But a lot of what chain analysis does, at least from some of my reading, is use these multiple heuristic types to try to paint a better picture. And every additional piece of information can help you sort of refine your analysis a little bit more. Some of the other important ones include address reuse. There's the change in output heuristic and the timing analyses as well. Those are all can help contribute to paint a more detailed analysis.
Would you mind helping break some of those down? So can you tell us why address reuse? What are the specific implications of that?
Yeah, I mean, so Bitcoin is at the protocol layer pseudonymous. Each address can be considered to be basically anyone. But once you reuse an address, that pseudonymity is destroyed. We know that the previous owner of a transaction or previous owner of an address is the owner of the address when it's reused, and you don't need to do any clustering. You don't need to do any merged input heuristics. It's just a fact. So that one is pretty powerful. It's not even a heuristic. It's just the way it is.
Right. And I guess just to unpack that a little bit further for the listeners who are not familiar, address reuse can impact not only the party taking payment, but also the parties who are making a payment, because they can be linked in some way, correct?
That's correct. Yeah, I mean, address reuse is a pretty big problem. I mean, during my research, I didn't even realize this until a little bit later, but OXT, which I'll probably talk about more later, does a couple of privacy metrics, and one of them is address reuse. You can go and you can check out any recent block, and you'll see address reuse anywhere from 30 to 50%. So it's pervasive.
Exactly. And you also mentioned the change output heuristic. Can you just outline what that is for the listeners?
Yeah, the change output heuristic is sometimes it works and sometimes it doesn't. That's the problem with these heuristics, is that they're mental shortcuts to try to shortcut an analysis to make it easier to do. And the change output heuristic is something along the lines of, I make a payment to Stefan, I send him, I have a 1.1 BTC UTXO, I send him 1 BTC, and the 0.1 is likely the change output, or something along those lines. It's sometimes they'll also pair that with round number payments, can help refine that a little bit further.
Right. And I think another component to add there would also be the index number of the outputs. So as I understand, I can't remember the exact BIP, but I believe there was a BIP that tried to standardize so if you've got a certain number of inputs and outputs to every transaction, and those outputs are ordered, and depending on how a certain wallet constructs or crafts the transaction, it may be that the change output was always the second one, for example.
Yeah, that's correct.
Right. And you also mentioned timing analysis. Can you just outline a little bit on how that could de-anonymize a person using Bitcoin?
We'll talk about it a little bit later, but I've been integrating this a little bit into my analysis. And it's that if you have at least enough of an idea of maybe what one entity is doing, you can sort of better refine your analysis by evaluating when their transactions hit the blockchain, or when the transaction first hits the mempool. And sometimes transactions from a single party might be all broadcast in the same block, and you can go back and you can pick through that. So that can help you sort of paint an even better picture.
Right. And another one that I can just think of now is also just around the way the script is constructed, because I understand certain wallets can be subject to fingerprinting analysis. So an outside observer trying to spy can try to understand, based on the way the Bitcoin scripting is crafted, what sort of wallet was used to create that transaction.
Yeah, that's also the case, and I think a lot of users are also aware of some of the issues with multisig in their current form. That once they're spent, you reveal how many parties are involved. This is similar to the scripting that you kind of just described.
Right. Yeah, that's great. So I think there's some of the basics, and potentially we should also talk a little bit about network level privacy. So could you just offer some overall thoughts on that, if you have anything to share on that?
Yeah, I'm not a network level expert, but there are, of course, issues with how you broadcast the transactions. Of course, everybody knows how important it is to run your own full node, to be using that to broadcast your transactions rather than a third-party server. Also, querying your own Bitcoin node to keep from revealing your address balances or sharing your XPubs. These are some common things that are problems, especially with some of these hardware wallets.
Great. And so look, yeah, I think that's probably enough on the basics. Let's now go a little bit into the story of how you came across this PlusToken and so on. So how did this first come across your radar?
Yeah, so at least kind of how I started off a little while ago was, I was sort of doing my own research on these non-custodial mixing services. And I was looking at the Wasabi mixer in particular, and I noticed that a single entity was basically merging a significant amount of Bitcoin. The initial tip-off to me that this was, a single entity was that this entity was experiencing a significantly high, amount of address use in the mixer. I don't know. I'd have to look up what some of the stats were. I think I found one transaction that was nearly 100% address reuse from mixed outputs, which is something that really shouldn't happen, but I guess can happen in some scenarios. And from there, I just sort of followed the merged input heuristic and watched these merged outputs as they were joined together into a relatively large cluster. Basically, sent to these merged transactions were sent to Huobi, an Asian exchange, in pretty large volumes, anywhere from 50 to 100 Bitcoin, or I think in some cases even up to 200. So it was pretty obvious that there was a very large entity using the mixer. I think my initial cluster estimates were around 2,600 Bitcoin, which is not chump change. And from there, I started thinking, well, if I found 2,600 on the way out, it's very likely that I could probably find this on the way in, which would be, sort of a timing attack. And so that's what I started doing. I looked back and found, some of these larger inputs were, all coming from a reused address for the most part. I shared that address publicly, and Laurent, the developer of OXT, I think he just took a quick Google and found that some of those addresses were related to PlusToken.
Wow, there you go. And so that's an example there of data fusion, right? Because those addresses had been publicly listed, and then any outside observer with enough knowledge and skill and tool sets, so kycp.org and oxt.me and so on, could, like yourself, could go and use those tools to try and understand or try and pierce through that veil, if you will, and understand what was going on. So can you tell us a little bit about the timeline here? So when did you first come across this, and what was the timeline of this PlusToken scam?
I guess maybe it's worth, going back and talking a little bit about PlusToken, at least sort of what we know. The available information about PlusToken is pretty limited. It sounds like it was pretty popular in Asia, particularly Korea, Japan, China. And a lot of the information is hard to come by. But I guess that the main point of this was that it was a Ponzi scheme. Users were promised some ridiculously high monthly returns. I don't know, something like 10 or 15% a month, which is outrageous. And just like most other Ponzi schemes, they pay out right up until they don't. I think that they started early in 2018, and sort of, I guess, really got some momentum early in 2019. I think that they may have had a few additional, kind of hiccups with their centralized server, which was, used to do their payouts. That was, I guess, up until late June, when a handful of the associates of PlusToken were arrested. I think they were Chinese nationals, but the data is pretty hard to come by. From what I understand, the ringleader was not arrested, and so I'm going to guess that the ringleader is the one that controls the private keys to these coins. So, June 27th or the late June arrests happen. PlusToken is basically shut down. We sort of have a couple of coincident events, including, the blow off top and, the exchange rate. And from there, I think things sort of remained quiet for a little while. There were a couple reports from others, some tweet threads, and I think some research reports about PlusToken that sort of surfaced in August or so that indicated that some of the funds were on the move. That's early August was when I originally noticed the first large whale deposit into Wasabi.
Wow. And so for a bit of context, from what I've anecdotally heard is that in other cases of big hacks, so like Bitfinex hack and some of these others, what actually happens is often those attackers just leave the coins waiting. They're not actually trying to sell them yet. It could be that they're waiting for a later, more opportune time. Maybe they're waiting for better mixing technology before they actually try and sell those Bitcoins. But in this case, it looks like they have attempted to, as we'll point out, I think they used some poor methods of trying to self-shuffle or running massive volume through one mixer and so on, or in an incorrect way. So let's talk a little bit about what do you think they were doing and doing wrong, as you pointed out.
It's hard to guess what exactly they were doing, but I think they were, trying to hide the movement of their funds. I know that there are some big links between Huobi and PlusToken, and that Huobi was one of the main sources of most of the PlusToken deposits. I don't remember what some of the percentages were. I think it was something on the order of 50 or 70%. It was a large amount. So in theory, Huobi has a decent idea of how much has gone to PlusToken. And from there, PlusToken needs to, if they're going to try to sell their coins, they need to do something. They can't just go straight from Huobi to PlusToken and back to Huobi. They're going to have problems. So I think what they were trying to do was to basically hide their transactions on the blockchain. And that sort of was through, I picked up two main methods. One was the Wasabi mixer, and I think around 20,000 Bitcoin were forced through the Wasabi mixer. And there's another process that I called self-shuffling. And, it's hard to come up with a good term for this, but it's easier to see than it is to explain. But it sort of is a repeated process of splitting the UTXOs and merging them back together. And this is not mixing. We would consider it mixing if they had identical outputs, but that is very rare. I think even in the cases where they tried to do it, Boltzmann, the OXT algorithm, was able to chew through that and still create some deterministic links. So the self-shuffling process is, like I said, it's repeated splitting and merging of transactions. Sometimes, I don't know, 100 transactions in a self-shuffle cluster before merging them on the other way out. And I had originally thought this might have been some type of tumbler or subpar tumbler, but now the more I've been looking into this, I'm starting to think it's just a manual process. And that sort of comes back to this timing analysis, where the self-shuffle transactions might sit for a few days and then resume, which to me is a little bit more of an indication that it might be a manual process.
Right, yeah. And so just for the listeners, would you mind outlining a little bit around what is a deterministic link and why is that a bad thing?
Yeah, so it's probably helpful to describe what a standard Bitcoin transaction looks like, or at least the majority of Bitcoin transactions. Like let's say I have 0.4 and I want to pay you 0.1. We'll have an input of 0.4, an output of 0.1, and a change back of 0.3 to me. And this is what most Bitcoin transactions look like. And in this case, we say that they're deterministically linked. The inputs and the outputs are deterministically linked because we can run the CoinJoin Sudoku algorithm on this transaction and verify that the input must have paid, the outputs. And this CoinJoin Sudoku, which is used to find deterministic links. It works not just in this case, with one input. It works with multiple inputs as well. And so deterministic links are bad because with all we have to do is look at a transaction, and we can say with 100% certainty that we know that an input paid an output.
Right. And on top of that, I've noticed as well with kycp.org, there are tools that help. You can type in a TX ID, a transaction ID, and it will assess that transaction from a Boltzmann point of view and from a deterministic link point of view. And it will show their deterministic links and also probable deterministic links. So can you just outline a little bit of how that assisted in your analysis? I presume you used that kycp.org as well.
Yeah, I started out using KYCP and sort of moved towards using OXT later, which is something we should also go over. But KYCP is a transaction privacy visualizer. It's used to show the relationships between inputs and outputs. So specifically, it will look for address reuse. It will look for deterministic links between the inputs and the outputs. If there are no deterministic links, it will show the probabilistic links. And it'll also show which inputs were merged into the transaction and which outputs were also merged into a subsequent transaction. So all of these things are sort of used to help elaborate on some of the privacy issues with the transaction.
Yep. And sorry, just one other thing while we're on that topic, interpretations. So the other thing that you'll see on kycp.org is interpretations. And for instance, in a Whirlpool transaction, it will show that 1496 possible interpretations. Can you outline a little bit about what that is?
Yeah, this gets to the concept of entropy, and hopefully I don't butcher this too much. But entropy is at least from my understanding of Laurent's mental model of a Bitcoin transaction, he looks at it as a flow between inputs and outputs. This is sort of a statistical mechanics or a thermodynamics kind of model. I guess the point is that you can see how inputs are paid to outputs. And from there, if a transaction has any type of coin join characteristics, and the most easily way to identify coin join characteristics is if there are identical outputs, then the transaction has what's called multiple interpretations. And sort of what this means is that if you have, for example, in a Whirlpool transaction, you have 3 inputs of, it's basically 5 inputs of 0.01 and 5 outputs of 0.01. You have no way of knowing that one of the 0.01 inputs didn't pay all 5 of the 0.01 outputs. There's just no way to distinguish that, in the code. I guess it's sort of a Satoshis don't have serial numbers kind of a perspective. So
Yeah.
I guess it's a little bit of a difficult concept, but if anybody that's had thermodynamics will sort of understand this intuitive concept of entropy. But what the algorithm does is, like I said, is there's no way of not knowing that one of the inputs didn't pay all of the outputs, or one input didn't pay 2 of the outputs, or one input didn't pay only one of the outputs. And this sort of gets to this idea of multiple interpretations.
Yeah, that's fascinating. And I think for listeners who really want to go deep on this, I would suggest looking at some of the discussion between Laurent and Adam Gibson, also known as Waxwing. There was some discussion around when Laurent first posted some of the Boltzmann scoring. But again, that's probably a little bit beyond the technical level that we can handle on this podcast today. But bringing it back then to the self-shuffling and then running massive volume through Wasabi. So let's bring it back to the behavior that you saw. So basically, they had this big pot of stolen money, and they want a way to try and get fiat out, presumably. And so that's where, as you mentioned, they were doing this quote-unquote self-shuffling process where they're not really mixing, they're just trying to obscure the traces on the blockchain by doing this kind of weirdly structured transactions that then later all merge back together. And I think you demonstrated this very nicely in some of your charts and some of the graphs that you were showing from oxt.me. Can you outline a little bit around your process there?
Yeah, so I think if we pick up sort of where I left off in the timeline, I had found the 2600 Bitcoin cluster on the way out of Wasabi, and went back and found the major reused address. And from there, I found that multiple branches off of that reused address were making deposits into Wasabi or into this self-shuffling process. And after sort of seeing enough of this, I was able to kind of come to the conclusion that, this is likely one entity that's trying to hide their funds. So, I think I had shared that PlusToken, I had shared the original address, and Laurent brought it back to PlusToken. And from there, he created a little bit of a diagram using OXT to illustrate the flow of funds between different clusters. And from there, I was able to sort of get at least a preliminary estimate of some of the size of the scam. And at the time, I wrote the Medium article. I think it was 50,000 or so Bitcoin self-shuffled and 19,000 or so that went through Wasabi.
You also point out in the article that it's approximately 200,000 BTC that was total in the amount that got scammed. So there might be more to come.
Yeah, that's correct. At the time I wrote the Medium article, I hadn't really done enough digging into the size and extent of the PlusToken Premix cluster. after I thought that for the most part they had finished, at least around the time that I was writing the Medium article, I thought that they were done. I found some self-shuffle transactions that were sort of stalled and weren't going anywhere. Some addresses that were full of funds that hadn't moved since the middle of August. And recently, they had started moving again. And that's when, I followed them through the self-shuffling process, and I found a reused address that was used to sort of collect transactions before sending them, typically to Huobi. Again, more address reuse. From there, I evaluated the history of that transaction and was able to, sort of verify at least how much through that address had been sold. I think by now, I think it's around 77,000 that I was able to cluster through that address.
Wow.
Yeah, I mean, it's starting to get, astronomical numbers. You sort of start to, lose track. But, after having looked at that, the most recent address reuse, with Huobi, I went back and decided that, okay, I need to really get a handle on what Premix funds are left. And that's when I sort of came up with the recent, tweet thread that estimated around 185,000 Bitcoin, at least in their Premix cluster.
Wow, so there's a lot more to come. And I think that also raises the question then that it was basically address reuse that enabled address reuse on the part of these scammers that enabled you to actually try and trace them, right? Because if they hadn't done that address reuse, it would have been harder for you to do that, right?
That's absolutely correct. Is that address reuse was a big problem, and it's been pervasive throughout this whole kind of process. It's been present in the premix. It's been present in some of the mixing. Well, actually, in both of the mixers, and it's been present in the postmix behavior. And I mean that really shows just how bad address reuse can be.
Yeah, and I guess that means now scammers will probably listen to this, and that means next time they won't reuse addresses, and that'll make this task even harder for next time, right?
Well, I mean, I guess part of the problem too is just the volume of Bitcoin that they've been moving. Regardless of whether or not you're reusing addresses or you're using a mixer or not, it's relative. I don't want to say it's easy to track, 190,000 or 180,000 Bitcoin, depending on what they do with it, but that was part of the reason too that I was able to notice the problem with the Wasabi mixer was that no one is merging 2,600 Bitcoin on the back end of a Wasabi mix. That's just crazy. So that gets to the it gets back to sort of a timing analysis problem that if you're going to do something with that volume of coins, it's got to take more than a couple weeks or whatever they were trying to do it in. It's probably a year process or longer.
Gotcha. Let's talk a little bit around their use of Wasabi then. So you were commenting a range of things, right? So there was some address reuse that initiated this investigation. As you mentioned, the timing attack. You also mentioned Sybil attacking. Can we talk through the process then from a Wasabi perspective, or from the PlusToken scam people trying to move through Wasabi?
Yeah, I mean, it's sort of like I said before, is that timing analysis is a problem for such a large amount of Bitcoin. And the Wasabi mixer is relatively big. If you look at some of their transactions, there might be anywhere from 20 to 100 Bitcoin that gets processed in I don't want to call it an average transaction, but in the majority of the transactions. And it's not enough volume for them to process 20,000 Bitcoin or 200,000 Bitcoin in the case of PlusToken. But like I had said before, I noticed this massive volume on the way out. So I started looking for a kind of a source on the way in. And after I had found the reused address that was used to do most of the deposits into Wasabi, I was able to use OXT's transaction graph to expand Wasabi transactions and follow them back to this reused address. And from there, I was able to get a little bit of an idea of how much of a hurry were the PlusToken scammers in. You can only mix so much with one mixing client, and so in order to speed up the process, it looks like what they did was deploy multiple mixing clients. This is sometimes referred to as a Sybil attack, and in a Sybil attack, the intent is often taken into account. But Sybil attacks are problems for all types of mixing services, where there is no reputation and you're trying to keep people anonymous. And usually, there are different ways to mitigate this, but like I said, the scammers were basically in a big hurry. They opened up multiple mixing clients, and they forced a large volume through Wasabi in a relatively short amount of time.
Yeah. And so it's probably fair to say that this is just generally just a hard problem for any kind of mixing service, and particularly those mixing services that are trying to remain non-custodial, right? So I guess just quick high level, there are some mixing services and so on that are custodial and they've been shut down. I think Best Mixer is an example. And then there are others such as Join Market and Wasabi and Samurai, Whirlpool, which you don't give up control of your Bitcoins, but then now the risk is Sybil attacks, correct?
That's correct. It's a problem that all mixing services have, not just Bitcoin. It's something that privacy researchers have been struggling with for a long time, and it's not something that we're going to really solve on this podcast. But it is an issue. It still needs to be addressed. And usually, what mixing services, at least in Bitcoin, do is they charge a fee, a mixing fee. And there are different ways to do this. Join Market has their maker-taker model. Wasabi has a volume-based and participant-based model, and Whirlpool, for example, has a deposit-based model. It's very hard to address this problem. The fee, at least in Bitcoin mixers too, isn't just a security measure; it's also an economic measure, and there are some incentives around there that can make it a very difficult problem to solve.
Right. And for example, I think I saw Chris Belcher on the mailing list talk about this idea of fidelity bonds as a way of deterring scammers, right? That they would have to post up some money so that it would make it harder for Sybil attackers, right? And that's just one example. But I guess just generally, what are some of the lessons that can be drawn from this in terms of mixing services and how they could mitigate this kind of problem or at least reduce it where possible?
Yeah, I mean, it's probably useful to talk about how much this attack might have cost. I did a quick estimate a little while ago, and I built a very simple model based off of just my observations of the mixed deposits from the PlusToken scammers, and the model still needs validation, but I think it's legit for most of the mixing. Through Wasabi. And I came up with a number estimate of around 12.5 Bitcoin. It's not entirely accurate, but I just wanted to get a ballpark number just so I could, for my own sake, think about this problem a little bit better. So we've got 20,000 Bitcoin sent through the mixer and 12.5, on the order of 12.5 Bitcoin paid in fees. It's like 0.5% or something. It's some negligible amount. You're not going to deter 20,000 Bitcoin getting forced through a mixer that way. And it's the same thing for Whirlpool. I think Whirlpool, at least based off my model, might have cost 3 times as much as the Wasabi mixer. But even if it's 50 Bitcoin, 50 Bitcoin is a drop in the bucket in this 20,000 Bitcoin problem. But there maybe are a little bit of lessons here. And it's a difficult problem to solve, but it's how do I want to say this? I only really have sort of the 3 mental models that we talked about before. We had Join Market, which has this maker-taker fee process. We've got Wasabi, which has this volume and participant-based fee process, and Whirlpool, which has this deposit-based model. And I sort of lean towards favoring Whirlpool's model because there's no way to not know that each mixed deposit isn't a new user. So you sort of adjust towards charging each deposit. Each deposit basically is what it kind of comes down to.
Gotcha. Yep, and there's also the importance of having good post-mix practices. So let's just, again, for the listeners who aren't familiar with mixing, can you just outline the typical structure then with premix and then post-mix?
Yeah, this is kind of a pretty cool concept. Even Join Market, from what I understand, had a premix tumbler where they would separate large mixed deposits and pre-prepare them for mixing. That way, nobody was trying to do what happened here with PlusToken and trying to run 20,000 Bitcoin through a mixer. Now, most people don't have 20,000 Bitcoin, but even if it's 100 Bitcoin trying to get run through, maybe a join market type volume or liquidity situation, it's going to be still a problem. So what they would do is they would pre-split their UTXOs. And so I guess maybe it's good to start with Premix, at least with, I don't think that Wasabi doesn't have any premix preparation, but Whirlpool does. It has their TX0. And the TX0 will take the fee. It will pre-split the transactions into the, premix, deposit amounts so that they're prepared for mixing. And this is a pretty neat concept, at least with Whirlpool, because what it does is it gets the mixed deposits to be very similar to the mix outputs. And this gets the mixer pretty close to an ideal coin join, which technically isn't possible, but Whirlpool is getting close. So that's I guess the premix, right? Do you want to talk about postmix?
Sorry, one other point, I guess, just to outline the way that might work. So, for example, if you're using Samurai, you might put in, I don't know, for example's sake, you might put in 15 million sats, which is 0.15 BTC. And if you wanted to put that into the 0.01 pool, what it does is it kind of cuts it up into 14 different pieces, and you would then have the unmixed change, right? So that part would get put back into your I guess, main wallet or whatever you want to call it. And then all those other pieces are basically like 0.01 with just a little bit more for the mining fee to account for that transaction. I think it might be important to also talk about the unmixed change at this point as well. Would you mind just outlining some of your thoughts around that?
Yeah, it's unmixed change is always going to be a problem, no matter what type of mixer. I mean, there's change with almost any type of transaction, except for one that's a true merge of multiple inputs to one output. So there's just about always some type of change in a Bitcoin transaction. And the same thing holds true for mixing services. Join Market, I think they have unmixed change technically in their mixes, but they have a little bit of a neat privacy twist on how they handle the change. This is due to their maker-taker model. It makes it hard to predict what the unmixed change outputs will be, because there's some transfer from the makers to the takers in that process. As far as Wasabi goes, I think that unmixed change is typically just included in the mix. It's paid back out to the mix participants in the mixer. And for Whirlpool takes the unmixed change and leaves it outside of the mixer and is taken as part of the TX0, which is sort of what we said before.
Gotcha. Yeah, great. And I guess we should just, while we're on this topic, just talk about how toxic that is and how bad that can be, because that can link multiple mixes together, and if the user is not careful. Could you just outline a little bit around that point?
Yeah, absolutely. And it's probably worth noting back to Join Market, who also did some of this, laid some of the groundwork for some of this thought process. They had this concept called mixing depth, where they would basically separate your mixed outputs and your unmixed outputs into different different parts of your wallet with different XPubs or different private keys, so that you wouldn't merge your unmixed change with your mixed outputs. And this is a problem that is somewhat hard to deal with, and they sort of did it a couple of years ago. As far as the Wasabi mixer goes, it's the unmixed changes, I guess, is technically included in the mix outputs. And users are the onus goes on the users to avoid moving that change. I think that they have a little red symbol to show how toxic the unmixed change is. And in Whirlpool, like we had said before, the unmixed change is kept separate, sort of similar to this Join Market style. And so the problem with this unmixed change is that if you merge your unmixed change with your mix outputs, then you basically will relink your pre-mix history with your post-mix history, and for the most part completely undo the privacy that you gain through the mixing service.
Yeah, great explanation there. So I guess let's move on then. So that's pre-mix part. Then let's talk through the mix and then the post-mix parts.
Yeah. So I'm not quite as familiar with Join Market as I probably should be, but from what I understand, they will the the maker will broadcast that he is willing to do a transaction, a CoinJoin transaction for a certain amount. They have a taker process where the taker pays the fee to the maker. They, come together in this market style, mixer, and they decide to do, a transaction for whatever amount that, basically I think it's the taker demands, but, the maker is broadcasting, and like I had said before, you wind up with, depending on the size of the join market transaction, a handful of identical size mixed outputs and, a little bit of unmixed change with some adjustment for the fee taken. The Wasabi mixer has a lot of moving parts to their mixing process. There are multiple mix outputs, is for one. And it sort of depends on the way that the mix outputs get done, depends on sort of who shows up to mix. If somebody shows up, a couple users show up with some larger mix amounts, then you'll have some larger mix outputs. But it's not really kind of set in stone. It depends on kind of who comes to the party. And then with Whirlpool, the idea is to try to, from my understanding, to try to get as close to this ideal CoinJoin transaction as possible. And so this sort of gets back to the TX0 concept, where the Premix coins are split and prepared for mixing, and they're basically the exact mix output plus a little bit for the miner fee. And on the way out, they all wind up with basically identical mix outputs. This is sort of gets to the concept of perfect or 100% entropy, which I know some of the Samurai guys are a fan of.
Great. And so then once you've gone through that mix, now you have to think about post-mix strategy. So what are some things that we should think about with post-mix strategy? And also, if you could just elaborate on that risk, that I think this is an underappreciated point, which is if you have just gone through a mix with other people, if those other people do not now take their privacy seriously in a post-mix sense, that can screw up your own privacy too, right? So there's like a externality, if you will. Can you just outline a little bit of the thoughts around that?
Yeah. Some people think that postmix is just as important or, more important potentially as the actual mixing process. As far as I know, I think Join Market implemented some type of pay to endpoint or pay join type transaction. Wasabi Wallet relies on users to perform coin control. And then the Samurai mixer, Whirlpool, has a couple of different post-mix tools that will keep users from hopefully merging, a lot of their mix outputs into a single transaction. And this is another sort of difficult problem to solve. You can't take full control away from the user while still, needing to try to enforce best post-mix practices. So, at least with Samurai, they have a couple of post-mix tools that will keep users from basically, shooting themselves in the foot. And then the problem is, I know that some people say something along the lines of, users need to do their own research and figure out how to do this kind of stuff. But, it's sort of like you said before, there's a little bit of a problem here when your fellow mixed participants decide that they, don't want to know what they're doing or don't want to pay attention. So like for the example with PlusToken, merging hundreds of mix outputs on the way out, affects everybody, negatively. So, and again, this is a difficult problem to solve, without, taking full control away from the users. But there are some things that people can do.
Great. And so let's keep it on PlusToken for now, and then we can come back to some of those other concepts around pay joins and Stonewall and so on. But with PlusToken and how they basically cornered the market, right? They've got a large, let's say they've got 200% of 200,000 Bitcoins. That's, close to 1% of Bitcoin's supply. And you were commenting on how there were some impacts on Bitcoin's market price and potentially even the run up. There might have been that artificial price run early this year. Can you outline some of your thoughts there?
Yeah, I'm not a markets expert, but it's I know everybody gets upset when number doesn't go up, pretty consistently. But it's pretty obvious to look back in hindsight and say that the run up maybe from March until June was a little bit overdone. And that might have been basically caused by these PlusToken scammers, just like you said, cornering effectively 1% of Bitcoin supply, and an artificially fast and an artificially large amount. So yeah, I really think that what's happening now is basically just working off a little bit of a hangover from that party. And I had tried to do some estimates where I tried to total how many coins were mixed and then estimate over the period of time since mixing started to come up with a little bit of an average of the daily distribution from the PlusToken scammers. And I think I had numbers somewhere between 1,100 and 1,300 Bitcoin, which if you put in perspective compared to the miner daily issuance is something on the order of 60% or so of the miners' daily issuance. So if miners are consistent sellers, or at least presumed to be consistent sellers, then this is pretty significant daily supply. So like I had said, this is probably mostly just working off a little bit of that kind of PlusToken hangover. And it's also worth noting that, of course, I do a tweet thread, and a few days later, they, for whatever reason, have slowed down the distribution to Huobi addresses, at least as far as I can tell. I don't know if it was in response to, I'm sure they're not on Bitcoin Twitter, but I don't know if it was that or if they were just shocked by the recent price drop. They didn't want the market to drop out from underneath them. So I don't think it's much of a big deal in the long term of things, but people like to speculate on the exchange rate.
Right, yeah. And so as you were saying, your estimate a little while ago, I think this was maybe 1 or 2 weeks ago, you estimated more selling like this for another 1.5 to 2 months. But as you're saying, they may have noticed this, or maybe there's now a bit of attention drawn to it, so they've tried to slow down the selling pace, potentially. Again, we're speculating here.
Right. I mean, all I have is I don't know what is about a week and a half of data since I did the last tweet thread. So I don't want to call it a new trend in that they're not selling anymore or that they've really cut down. Maybe it's just a pause, but we'll see how things go going forward. Maybe they'll get back in the groove and start doing what they've been doing.
Yeah, maybe there's only so much they can spend in on all the whatever they're spending it on.
Yeah.
All right, so let's talk then about lessons for listeners coming out of all this. Are there any lessons in terms of impact on mixers?
Yeah. There's a couple things, I guess. We sort of talked about the Sybil behavior before, and it's something that is just always going to be a problem, but just something that users kind of need to be aware of. There are definitely, lessons, like we had said. The address reuse is a problem, right? For all of Bitcoin, and users just sort of need to be aware that this is kind of going on. Like I said, I sort of recommend people go and spend a little bit of time on OXT and take a look around. I had mentioned earlier that address reuse is pretty crazy. Anywhere from, like I said, 30 to 50% or so, and it's basically because most of the economic activity on Bitcoin is exchange to exchange trading. So, exchanges are a bit of a problem here. There are some other things that users can sort of take away. It's to try to, I guess, avoid merging your inputs, basically whenever possible. There might be some times where you can kind of get away with it if you have a fancy algorithm. But, it's really is a good idea to learn coin control and try to keep, your Bitcoin receipts separate. Those are basically some of the two biggest things that users could do today.
And in terms of fee calculation, and here we're talking like for the CoinJoin providers, right? So Join Market and Wasabi and Samurai. Are there any impacts there in terms of how we think about fees, how we think about anon sets as well coming out of mixes going forward?
Yeah, this is probably going to make some people upset, but Wasabi has decided to do a volume-based and a participant-based fee structure. That's the way that they've chosen to do it. And it makes economic sense. It sort of is this, you pay for what you get, and you're basically paying more for mixing more, which makes perfect sense. This sort of gets into maybe a little bit of a problem with this kind of Sybil behavior where, you don't know for a fact that each new deposit isn't a new user, which is why I sort of appreciate the Whirlpool model a little bit. So that might be a little bit of a takeaway, at least when it comes to that sort of Sybil fee structure. Maybe there are a couple others as well. It's that preparing your coins for mixing is also important. Sort of this TX0 concept or this join market tumbler concept where coins are somewhat prepared so that it's not an obvious, massive inflow from the same user. And then you have the postmix lessons as well, which is again a difficult problem to solve. But enforcing hopefully best practices is encouraged going forward.
Great. Yeah. So I guess, there's potentially some things that the mixing services and products will have to consider coming out of this. And in terms of what are customers getting for what they're paying for. So, for example, if there's a lot of Sybil users in a mix, then it becomes difficult if you're charging based on how many users, right? So I guess it's just a difficult problem. There's not necessarily an easy answer here. And from an exchange perspective, are there any lessons there? I mean, off the top of my head, they should stop reusing addresses and not have static deposit addresses if they are using that practice, correct?
Absolutely. It's absolutely terrible. Bitcoin, is the way I sort of look at it is like I had said earlier, through this crypto anarchist lens, which is privacy is pretty important. I know that a lot of people are interested in the economics of Bitcoin, and I am as well. But these exchanges are just terrible for privacy. Between the on-chain privacy, the KYCing yourself, it's absolutely terrible. I'm sort of been really getting into this concept lately of gray markets and peer-to-peer Bitcoin is probably better than KYCing yourself. But I don't think that people are going to stop gambling on Bitcoin anytime soon. It's just kind of is a shame that it sort of has gone the way that it's gone. But that all being said, is maybe the market will hopefully come up with a way to maybe punish exchanges for their poor privacy practices.
Right, and even in a KYC world, at least if exchanges stopped reusing addresses, that would at least help, right?
Yeah, absolutely. I mean, I'm thinking of people in the future, and I know that this happens already. Front running deposits to static exchange addresses. If exchanges are getting front run and not making as much money as they should be, they should be incentivized to fix that. But anyway.
Right, yeah. Well, I guess it depends on if the exchange is the one losing the money, because the exchange is taking a fee for the transaction as opposed to the individuals who are trying to buy, or, the person who got front run in that example.
Yeah, that's a good point.
Yeah. But anyway, I mean, that's a broader question, and I think things like Liquid may help there as well. But let's turn now to privacy more generally, right? So we were talking about it before. So, I mean, we've kind of covered the PlusToken stuff and what they were doing with Huobi and so on. Let's talk about your thoughts around acquiring Bitcoins then in a more crypto-anarchist compatible manner. What are your thoughts there?
Yeah, I mean, it sort of gets back to, some of the things that I was learning about earlier this year, which is, just what are the three sort of main aspects of Bitcoin's privacy? We have on-chain, we have network, and we sort of have how you acquire them. And the how you acquire part is my opinion very important. The KYC is pretty bad. The pseudonymity of Bitcoin is pretty powerful. Without any additional information, the network level and the on-chain level, don't matter quite as much if you've acquired your coins through a KYC method. So hopefully I like to see more of a peer-to-peer style Bitcoin self-sustaining economy kind of going forward.
I guess your main tip then is basically to not use KYC services. Do you have any thoughts around individuals? So, for example, they might be thinking, okay, I might buy from a KYC exchange and then do CoinJoin afterwards. What's the big deal with that?
Yeah, this is fun. You can't un-KYC yourself. KYC is forever. So there will always be that real world link between how you bought your coins and all of the tag along information, driver's license, bank account number, how much you bought, when you bought. The exchange is not going to forget that. They'll know that you withdrew your coins to an address, and then from there maybe sent to a mixer. So, okay, you might break the links between, your withdrawal address and, the exchange might not know what you've done with them going forward, but they're just not going to forget that you bought those coins. So it's, and the same thing sort of holds true for network level privacy. It's like, even if you are using your own full node and you are not sharing your XPubs and you're checking all the boxes, it's not going to matter. It's not going to un-KYC you. So I think it's just sort of important that that get reiterated.
And so in terms of privacy today, I guess you've done a lot of white hat chain analysis. Do you have any views on how easy the average user would be to be de-anonymized? Like basically what I'm asking is, how bad is it today?
How bad is it today? It sort of gets back to, I don't want to keep beating a dead horse with this KYC thing, but that's very important. As far as network level privacy, we've got our own full nodes, we've got Tor, and we've got all these add-ons that are coming to Bitcoin Core in the future that should be pretty good privacy enhancements. And then when it sort of comes to on chain, you sort of have to think of what are you trying to defend against? We think of these chain analysis firms. They're sort of universally hated for basically trying to bring the panopticon from fiat land to Bitcoin, and so they rightfully should be hated. I think that there's a little bit of embellishment on their part and sort of what they're doing and what they're actually capable of. There's probably a lot of disinformation into what they're actually doing. I think for the most part, they're locked in with exchanges and they're just monitoring users transferring from exchange to exchange. And on top of that, maybe they're doing clustering and they're doing all the other heuristics that we talked about earlier. For now, I don't think that they're quite as advanced as they maybe like to advertise that they are, but that doesn't mean that they won't be in the future. And so, hopefully Bitcoin is going to be able to stay a couple steps ahead of these chain analysis firms. Hopefully with the advent of these non-custodial mixers that are a lot easier for users to get their hands on, is that the chain analysis data set basically becomes useless junk. Hopefully that's the way things will go. But if Bitcoin sort of really does take off, you can bet that chain analysis is not going to remain where they're at. I know we talked a little bit about before this these deterministic links and between inputs and outputs in a transaction, and that if your inputs and you do coin join, you wind up with probabilistic links instead of deterministic links. Well, it's very likely that in the future chain analysis will develop this probabilistic model and do sort of a lot of the things that we talked about, to paint a better picture, including timing, address reuse, and all the other problems. So it's, is it awful? I think that we probably have more of a KYC problem than we do of an on-chain problem. But, hopefully with a lot of these new services, Bitcoin on-chain privacy just gets better.
That brings the question then around what approach we're using. And some of this comes into, as we were talking about earlier, things like PayJoin, things like Stonewall, or manual coin selection. So let's talk a little bit about the use of some of these techniques and where they may help. So perhaps let's start with pay to endpoint, or also known as PayJoin. Can you talk about what that is and how that helps break the heuristics?
Yeah, so there's sort of are two problems with Bitcoin's on-chain privacy. There's the transparent addresses, which allow you to basically create the a transaction graph, and then there are transparent payment amounts. None of these things are hidden with confidential transactions or some type of shielded address. It's out on the open. So what can you do to sort of address these things? We have the if you want to address the transaction graph problem, you'll do a typical coin join. That could be any of the mixers that we talked about, as well as Samurai has some additional tools that you can do in your normal wallet, or you can do from postmix. That's such as Stonewall, and Stonewall is it's a little bit of a stealth technique, but what it basically does is it's a simulated one wallet coin join. Rather than being multiple users, it will take a couple of your UTXOs and perform a mini coin join, and that will break chain analysis merged input heuristic. The merged input heuristic, basically operates under the assumption that will basically result in a cluster. And if you do a coin join, you either have to cluster everything, or you have to say we can't include this in the cluster. So that's one way to attack it is via coin join in any kind of traditional coin join, at least. And then you mentioned pay join or pay to endpoint before. Pay to endpoint's really pretty cool. It's basically a regular Bitcoin transaction, and it looks exactly like a regular Bitcoin transaction. But because you're involving the recipient of the payment in the transaction, it basically hides the payment amount. So the transparent payment amount never shows up on the Bitcoin, never shows up on the blockchain. So that's pretty cool. Hopefully, some of these mini coin joins get adopted or some more widespread use.
Yeah, that's a great point. And I think one thing we have to be wary with that, though, is in order to do that sort of pay join. So my understanding is Samurai Wallet has a feature called Stowaway, which is, I think, either it is that or it's similar to that idea. So, for example, let's say I wanted to pay you with a Samurai Wallet Cahoots transaction. And in the process of doing that, I think there's like a QR code back and forward process that you and I would share. And now you would not get control of my UTXOs, but now you would have increased visibility into my UTXOs, correct? And so that is potentially a vector as well, because if everybody starts doing a lot of these pay to endpoint or pay joins or join market pay joins, then people do start getting at least some visibility into their transaction partner's UTXO set, correct?
Yeah, that's correct. I mean, there's always this sort of coordinator problem of how do you construct the coin join transaction, whether it's Samurai Wallet Cahoots or join market or Wasabi. There are some trade-offs to basically each of those systems for trying to construct the transaction. As far as I understand, there's the maker taker model in join market where the taker gets all of the privacy because or the taker is the only one that gets all of the privacy. And Wasabi, they've done a pretty good job with their coordinator to keep things, from revealing too much information. And Samurai Wallet is somewhat similar, but these sort of in-person things, they require a level of trust between you and a buddy or something along those lines. And sort of at that peer-to-peer kind of level, it's really not as much of a trust issue as it is trying to trust some total unknown third party that your friend's gonna dox your coins or something like that. So it is a concern, but it doesn't seem to be too big of a deal.
Great. And one other question around the use of Stonewall. So let me put this in context. So let's say somebody is stacking Bitcoins, right? And they want to stack sats, right? And they want to, and they might have a cold storage, some kind of cold storage setup, whatever that is. They might have multi-signature, whatever they've got, and so they might acquire those Bitcoins, however they did that, right? Whether that's KYC exchange or mining or earning it with BTC Pay Server or whatever, and then they might run that through a mix, and then the question is, how would they now spend into their cold storage without obviously doxing? Okay, this is my cold storage, right? And so I guess there are two main approaches that I have seen here. One is the manual control approach, where you literally take each coin-joined UTXO and directly spend that into a new address in your cold storage setup. And then the other approach is the kind of more algorithmic Stonewall style approach, which creates only probabilistic links, but not deterministic links. What's your view there? Do you agree that that's a good summary? What's your view there on that kind of thinking?
Yeah, I think that's a pretty good summary, right? You can either spend from your, to your cold storage with, the manual selection one at a time, or you can, use these algorithmic methods. And so the algorithmic method, might provide you with some, additional, privacy sort of in the short term. The manual selection is, like you said, will be deterministically linked. You've got at best, you'll look at the blockchain and someone will know that maybe that was a self-spend or something along those lines if it just sits for quite a long time. But both of them are sort of subject to this time decay, problem that maybe isn't so much of a threat right now with chain analysis, but could be in the future. If your coins sit for it's sort of like the reverse of trying to force too many coins through the mixer at once. If they sit for so long, then you can sort of maybe gain some additional information. If I saw 5 Bitcoin go in and I see 5 Bitcoin sitting, you might be able to sort of come up with a little bit more information about those coins. So users are not going to leave all of their coins mixing all of the time. It's just not the way it's going to be. Nobody wants to keep all of their coins in a hot wallet. So if you do mix your coins, at least in my opinion, and you do spend to your cold storage, is that you should just be prepared to remix your coins in the future. I know a lot of people are big proponents of always be mixing, and that's probably true here. But I just think that users need to be prepared to be spending directly from mixes to a third party, coming in the future.
Okay, great. So you were talking there around cold storage practices when you combined with coin joining, right? And so because most people don't want to leave the keys hot, they're not just going to be perma coin joining on their cold stash. Now, maybe in the future, some people have talked about ideas around this with PSBT and so on. But for now, let's just say people are not mixing their main cold stash, right? Or main storage, right? Or hodl stack or whatever you want to call it. But there is an implication, as you were saying, around timing analysis and decay. And potentially that means people have to be cognizant that they may need to coin join on the way out of their cold storage as well. And one example, and maybe even before we get to that, is just this idea that if you were to, let's say, spend out into your cold storage and then later you needed to spend all of that cold storage into a new set, well, now at that point, what are you doing? You're potentially going to merge all those outputs together again. And unless the tools that you're using for your cold storage also have that kind of tooling to do coin joins, which likely they won't, then you've got to think about that too. And or the other way is potentially to do it UTXO by UTXO and just move, even if you've got 100 different outputs, to move each of those over individually. But then I guess the lesson then is, even on the way out of cold storage, you would have to think about that in terms of, okay, maybe I'll run it through a mix and then do a post-mix spend on that.
Yeah, absolutely. I like we said, users aren't going to leave all of their coins hot, even with some potential possibilities for cold cold mixing, in quotes. So it's probably at least the way I think about it is that if you're going to coin join and you're going to send back to cold storage, just be prepared to mix again in the future and spend directly to a third party from a mix, because that really is sort of how these things are designed to be used, at least in my opinion. I know that like we said, it's not going to stop users from mixing to cold storage, but just as long as they're prepared to mix again, I think that we'll be okay. Because it sort of gets back to this concept of what really are the best. What is CoinJoin really best for? I know we talked a little bit about kind of transaction graph privacy. We talked about hiding the payment amounts and all of these sort of technical things. But at the end of the day, you don't want your counterparty to know your Bitcoin's history. That's really where CoinJoin kind of shines. So that's why I think it's really just best to spend directly from a mix to a third party.
No, great points, but let me just slightly push back there. Well, maybe it's just a question of tooling right now. The tooling right now is not easy to use to do that. So, for example, if you want to spend straight from the mix, well, in the case of Wasabi and Samurai, you can't really do that because it dumps it out back into your address right now. And with Samurai, it gets dumped back out into a postmix section, right? It's not spending directly to the party that you want to. And also because of the equal input and equal amount that are being coin joined, unless you're going to pay someone exactly 0.01 or 0.05 or 0.5 in the Samurai model or 0.1 in the Wasabi model or those other mix amounts. Although, as I understand, Join Market does have some Tumblr algorithm or script that you can use to say, I want to pay to this address and then mix it directly there. But what's your view there?
Yeah, I mean, that would be an interesting, addition is to mix directly to the third party. But that's, a very technical problem that, has a lot of, I guess, technically issues. I keep just going back to spend directly from the mix. You're going to have maybe these little bits and pieces, or in the Wasabi model, you're going to have, these deterministic links. But at least the way I sort of see with Stonewall and Samurai's, model is that Stonewall prioritizes the change from a previous transaction. This is to sort of reinforce that model of, is this really one wallet or two wallets? So that sort of helps take care of it, which is kind of neat. I noticed that a little while ago. But you're still going to have either these sort of deterministic links or these little bits that you kind of have to deal with in the future. So it sort of is kind of the function of Bitcoin's UTXO model. There's just always going to be sort of some kind of change to be a little bit of a problem.
Right, I see you. Yeah. I think I might have misunderstood, because you were saying spend directly from the mix, whereas I interpreted you, I think from my earlier comment, of spending like the result of the mix going directly to the third party. But what you're talking about is more like having a post-mix strategy, basically, and doing it correctly from a post-mix point of view.
Yeah, it's are you paying to someone else or are you paying to yourself? That I think might be maybe a little bit of a disagreement there.
Gotcha. Okay, so the other cool thing is Stonewall. With the algorithm, my understanding there is that it will try to include extra inputs into the transaction to basically make it less clear what is actually being spent and who owns what.
Yeah, that's correct. I think we said before, Stonewall is a simulated, coin join. You control all of the UTXOs, but if you look at it on the blockchain, it looks similar to a traditional coin join. I think the way that the Samurai guys have the algorithm tooled now is that you've got basically your payment amount, it's got an identical output, and then you've got two identical quote change outputs. So you wind up with sort of 4 UTXOs typically. Well, you wind up with 3. The person that you're spending to winds up with 1, and so it's pretty neat. But you sort of you wind up with two little bits of 2 anon set kind of coin joins.
Right, I see you. Yeah. And then then the question then is, what would people do with those other little leftover bits? Or would they just sort of continually accumulate?
Well, I guess if the exchange rate does what we think it will do, these little bits become more and more apt to spending. I think that sort of is number one. And the other thing is that the way that the algorithm works is that you can merge some of these little bits into a larger transaction that will still have higher entropy and a higher number of interpretations that we had kind of said before. And then from there, I guess the logical thing is, okay, what do I do with all these little bits? You basically have to remix them. I know that Samurai has some plans for that, kind of going forward, which hopefully will be pretty neat to see.
Yeah, that's awesome. I'm looking forward to seeing that as well. Okay, so yeah, I think we've done a pretty big, comprehensive talk through a range of different topics. Are there any helpful resources that you would like to point the listeners to? Anything around the Boltzmann algorithm or any other helpful resources?
Yeah, I mean, probably the best resources is for users to just go out and play around with, the block explorers that we sort of mentioned before. We mentioned KYCP, we mentioned OXT. OXT is really pretty cool. I've even seen some other users recently, looking to track some, scammed or stolen coins and tweeting about it is pretty cool. But it has a nice transaction graph feature. Instead of looking at blocks of text, you can play around. And it doesn't even have to be your transaction. It could be somebody else's transaction. And again, the good things about those sites is that they have sort of these privacy, algorithms built in. I recommend that users read the gist sections of Laurent's Boltzmann posts. I know you had mentioned before the comment section of the first gist between Waxwing, Adam Gibson, and Laurent was pretty neat. I like that one particularly because Adam was coming at it from a okay, but what UTXO is the payment to the third party, which a lot of people sort of try to impose on Bitcoin. And Laurent's kind of stance is that the blockchain doesn't really see which user received the output. So that's a pretty neat back and forth that I recommend people go and read. I also like Gregory Maxwell's original Bitcoin talk posts. Those are great. And beyond that, maybe there's a fistful of Bitcoins is a useful research paper. And beyond that, I know it's not really it's usually frowned upon to come on and talk about another podcast on a podcast, but Bottom Shelf Bitcoin episode 25 with Adam Gibson or Waxwing was really very helpful, especially for me in sort of getting a good handle on a lot of this stuff. So I think users would be really, if they don't want to do any of that other stuff, and they're into podcasts, go check that out.
Okay, sorry, looks like you just cut out there for a second, but I know the podcast episode you're talking about, it was a good episode with Adam Gibson on the Bottom Shelf Bitcoin show. And I guess the next question I've got is just more around your views on the future of chain analysis, right? So to some extent, we can view the use and creation of some of these tools like kycp.org and oxt.me and so on as ways of doing the white hat analysis on ourselves before somebody else comes and does it on us. Where do you see all of this going in terms of the next steps for, let's call it black hat chain spies versus the white hat privacy activist types?
I wish that there was some more information about what chain analysis is actually kind of doing now, but of course they're not gonna let us know that. You'd have to be in on their sales pitches to really get a good handle on it. But I think that hopefully Bitcoiners will stay a couple steps ahead of them. Sort of just like you said, we have some of these privacy algorithms that maybe they're aware of, maybe they're not, and that Bitcoiners will probably stay lighter on their feet than chain analysis is even capable of doing. So hopefully, we can just sort of stay, a couple steps ahead of them.
Right, yeah. And also, did you have any thoughts around the combination of things like coin join techniques with Lightning?
I really haven't spent too much time looking into that yet. It's there's just only so much time in the day, and I chose to start with CoinJoin, and specifically on chain. Hopefully, I'll find some time to look into that in the future.
Great, yeah. I think that's an interesting potential combination in the future as well that we may see. So, yeah, I guess were there any other points you wanted to bring up, or I think that's pretty much it. So, if you've got anything else to say, and also just say that, and also just let the listeners know where they can follow you online.
No, I think we're pretty much all set here. You guys can find me on Twitter at ErgoBTC. Just hit me up with any questions. I'd be happy to help you out.
Fantastic. Well, thank you for joining me.
Thanks, Stefan.
So how cool was that? Do you think the PlusToken scammers are why the market shot up so fast earlier this year and why this recent dump happened? Or do you think it's probably not the most important factor? Either way, I hope you took away some tips on how to protect your own privacy. I've also got an announcement. I've just been announced as a speaker at BitBlockBoom August 22nd and 23rd of 2020 in Dallas. So use the code LAVERA and you get 30% off. The website is bitblockboom.com. Remember, if you like the show, remember to retweet and share it out with your friends. As always, you can get the show notes and the transcript on my website, stefanlavera.com. Thanks for listening, and I'll see you in the Citadels.